Welcome to the Insightful Investor Podcast, a weekly series that seeks to share industry, investment, and market insights. Learn more about our show at insightfulinvestor.org. I'm very excited to have Bob Prince join me today. Bob is the Co-CIO of Bridgewater Associates, where he's played a pivotal role in developing the firm's investment process and strategies for nearly 4 decades. Bridgewater is one of the world's largest hedge funds. Bob, I'm really happy you can join me today. Thank you.
Thanks, Al. It's good to see you.
Likewise. Let's go back to the beginning. When did you first become fascinated with investing, and what initially sparked that interest?
I'd say it was stages, I remember when I was a kid, my granddad used to read the Wall Street Journal. And I was like, wow, what is that? And I remember growing up, it was a small town in Illinois, and I thought, wow, wouldn't it be great if someday I could read the Wall Street Journal and actually understand it? So that was an early stage. And then, just through college, finance, and then I think worked at a bank. I did asset liability management at a bank and portfolio management. So just naturally drawn to it, And then I think when I was, it was at a regional bank in Tulsa, Oklahoma, actually, what was then First National Bank of Tulsa, First Tulsa. And even though we were smaller, we were pretty advanced in the things that we did. We were pretty well connected with the big money center banks in New York and the coasts. I worked for a guy, David Moffett, I was 24, he was 30. So, but he was a really smart, progressive guy. And between the two of us, we did a lot of interesting things. But we came into contact with Bridgewater and Ray as a research firm doing economic research. And I was really intrigued by some of Ray's perspectives on how economies worked, how markets worked, and also in particular, how market events could play such a big role in your life or your career. And that resonated with me because having grown up in Illinois, I saw how the strong dollar really had a big impact on Caterpillar and all the people that worked around me that worked at Caterpillar, right? And then I moved to Tulsa, and we were, I think Money Magazine had Tulsa as one of the top 3 cities in the country, for growth. And this was when oil prices were going up, and Boston was a total disaster, 18% unemployment in Boston and 3% unemployment in Tulsa. And then oil prices fell and everything flipped, right? And you just realize I'm working at a bank, and you realize, I could do everything right, but the world is flipping upside down and it's having a huge impact. And that perspective is something that Ray really put forth with respect to what we call risk management plans, helping companies and banks understand market risks in their business. And it just made sense to me that, well, you got 2 choices. You could either sort of sit here in your job and let these things whip you around and try to deal with them, or you could sort of get off the planet and choose to go long or short any one of these markets. And now it's totally up to you. You could go short oil, you could go long oil. You don't have to just be long oil because you live in a certain city and have a certain job. And that was really the beginning of me coming to Bridgewater and working with Ray and building out what at that time was the kind of the predecessor of Pure Alpha, which was, I think, the day I came into work, we had $380,000 under management in this little thing. But it was basically still we managed along those lines, right?
That's pretty fascinating. So when you start, obviously the learning curve is very steep, right? You're learning something new every day. Do you feel that even today the learning curve is steep? Meaning, have you learned everything you need to learn, or you still have a long way to go?
It's super steep, which is why you do this, right? You manage money. I always thought, you could be 90 years old. You could have outperformed the market for 60 years consecutively. You don't know about next year. So, yeah, I think you're continually, first of all, the world is shifting. And in some ways it's shifted in ways that you understand it and you're measuring it and you're responding to it. In some ways it's moving, new things are happening that weren't there before. And you need a framework for processing those new things. Like today, we think we've moved into this world of mercantilism, right? And where governments play a much bigger role in the economy. And so, okay, how does that work? So that's, in a sense, it's a learning experience, but in a sense, it's also a testing experience. It's a testing of whether what you thought was true before could actually be applied to this new set of circumstances or not. We've just actually built out a whole new part of Bridgewater called Total Portfolio Strategies, which is building from the asset return, not building from the alpha return. And so trying to build out great new strategies that have really unique characteristics is it's challenging, fun, exciting. I mean, and then you held to your results, you know?
Yeah, one of my golden rules in my career development has been if I ever feel like the learning curve is flattening, then it either means I'm overconfident or it means that I'm hanging out with the wrong people. And I need to surround myself with people that will steepen my learning curve. One of the benefits of working at Bridgewater is you're constantly bringing in really smart, the smartest in the industry, people surrounding yourself, challenging yourself, and that keeps the learning curve steep.
And the clients, we have smart clients. And so which is a privilege to be able to engage with the best in the world at what they do and try to partner with them on their problems and goals. It's all part of that learning process.
And so you've been there about a little under 4 decades. What would you say are the most enjoyable and gratifying aspects of that experience?
It's what we're just talked about. It's the discovery. It's discovering new things. And I think then discovering new things with others that you like and respect, being in that together, you learn from them, you bounce things off of them. And then to be able to do that and serve like the best clients and to have that relationship. So it's that whole synergistic, reflexive, or whatever process of the problem, the idea, the group you're doing it with, who you're doing it for, and then just continuing to cycle through that is really it's really much more of a continuous process, I think.
Yeah, and it involves periods of struggle. If it was easy all the time, it wouldn't be as gratifying.
Yeah, and I think the struggle comes in your first case when the overconfidence, the proverb, pride comes before the fall. You think you got it all figured out, and then guess what? The markets remind you that you don't. I always think about losing periods as that the markets have surfaced something that was always a weakness. You just didn't know it was there. It was always there. You just didn't know it. The market surfaced it for you. And now that it's surfaced it, now it gives you a chance to do something about it. And then that's what fuels the improvement process.
Right. Pain plus reflection equals progress.
I've heard that.
A few times, I'm sure.
Quite a few times, actually. My son wrote it on his marker board one day.
Oh, I love it. I love it. So what I'd like to focus on, and we've talked about this, is to zoom out a little bit and focus on what the average investor needs to know, but often overlooks when building a portfolio. And as we've talked about, the vast majority of investors probably fall into that camp. Even the people who are experienced and quote unquote sophisticated, because they tend to make similar mistakes and have similar fundamental oversights. And I think it's also helpful to divide our conversation into two categories. There's the portfolio engineering side, think of it as like the science of investing. And then there's the whole psychology of investing, and not about getting into investors' heads, but rather how do you practically implement what the science recommends? And you have experience, obviously, in both areas, sitting in your seat. So let's start with the science. There's a lot of uncertainty in investing. And at a high level, what would you say are the aspects of investing that you feel the most confident about, and which do you find more uncertain or unpredictable?
The things that you could be most confident in is the structural characteristics of an asset. And meaning, what is the nature of its income stream? How is it priced? I.e., what's the discount rate on that income stream? And then as you look at those things, how are those things affected by the environment? And so we refer to that as the environmental biases of an asset. So, for example, equities, it has the bias to do well when growth is strong. Now, you have to then qualify that with another point, which is relative to discounted. So, another basic principle is that all markets discount some future scenario. And when you get to the asset class level in particular, they discount economic scenarios. And then returns are driven by how things transpire in relation to what was discounted. So there's always a path that's discounted, then there's what actually happens. And the difference between what happens and the path is the driver of the returns. And the bigger the difference, the bigger the return up or down. That basic characteristic is true of every asset. And so that's really the starting point for understanding. That's what I mean by the structural characteristic of an asset. And then I think when you go to the asset class level, stock market, the bond market, commodities markets as a group, there are really four big drivers of those. There's economic growth and inflation. But then there's what we refer to as the discount rate, which is essentially we can think of it as the real interest rate. And then there's the kind of the general risk premium for liquidity. And it's those four things that come together that drive about 80% of any one asset class. So those are some fundamental building blocks. And then given those building blocks, then there's what do you do about it? Do I try to balance my exposure to these things? Do I have a view and I want to tilt to benefit based on my view? And then even before that, do I have the capability to have a view better than the markets, which have already discounted their own view? Right. So if the markets are always discounting some scenario, there are a lot of smart people out there that do this for a living, that work day and night with big teams and computers and data and everything else to figure out what is the future scenario for whatever matters to that asset. And that's now priced in. Now, are you going to bet against that? Are you qualified to bet against that? Right? So you have to be very humble in making that determination. Otherwise, you're the one that's going to be taken advantage of by the people that really do know what they're doing. And so, even for us, like we're a professional investment manager. We are super careful about what markets we go into and what we don't. And we're very restrictive about where we actually go. We don't walk into the room until we know we're as good as anybody else at the table, right? Or better than if you put the five best people in the world at the table. My basic criteria is if you put the five best people in the world in a room, and if I walk in or one of our people walks in, can we add value to that conversation? And if you can't do that, you should be very skeptical about whether you should be making bets in that market against relative to what's priced in. And if you can't do that, the best thing you can do is diversify, because you don't have to have a lot of expertise to diversify. And that's a very straightforward approach of just recognizing stocks, bonds, commodities, and how their biases exist with respect to growth and inflation, and creating a proper balance between those things. And that's 80% of all of what you need to do to build a portfolio that can achieve your objectives. Anyway, so recognizing that's the game you're walking into, and knowing how you're going to get the most out of that, but not also be, hurt by it.
Yeah, and I think if you simplify it even further, you compound wealth over time by just being exposed to the returns that come from being invested. And there's a lot of ways where you can mess that up, right? You can be out at the wrong time, you could get in at the wrong time. So what is fairly reliable is if you're just in asset classes, you'll achieve good returns over time, you'll compound over time. And there's different ways to think about how do you diversify that. which increases it shortens the time frame over which you can be successful, and it reduces the risk that you go through a very long period where you're unsuccessful.
Yeah, I've got your four major mistakes, and I want to add a couple to them. What you said: poor diversification, buying high, selling low, having a short time horizon, and overconfidence in predicting the future. I touched on a couple of those. I would add a few more things to that. I would add knowing what you don't know. Like, I guess that's sort of overconfidence. But I would say overconfidence, but also over fearful. Those two things work together. And typically they occur when you're taking too much risk. So if you have to know how much risk you are taking, how much risk you can tolerate, and don't take more than that. Because what happens if you're taking too much risk, fear takes over when you're losing and you sell at the bottom. And that's what causes one of, this selling low, right? That you're taking too much risk and you're selling at the bottom because you become fearful and not logical. Whereas if you take a proper amount of risk, you can sit through those ups and the downs and you can keep an eye on the long term. And then that goes to the last point, which is the power of compounding you were just talking about. People massively undervalue the power of compounding. And so if you have a more diversified strategy with the proper level of risk, and you hold that strategy or execute that strategy consistently over time, the powers of compounding are going to work in your favor. I think that's one of the biggest things Warren Buffett has done. If you look at his basic approach is compound cash flows over a long period of time, compound an effective rate of reinvestment over a long period of time, and just keep doing that.
What I think is really fascinating is what you just described makes perfect sense. The math would support it, and I don't think anybody would argue against it. Yet when you turn on the TV or read the Wall Street Journal or anything like that, it doesn't really talk about that. It talks about here's what we think the future holds, and here's how we would invest given that expectation of the future, which is on the other end of the spectrum of the things that you can be highly confident about.
Yeah, and that's where we are right now, right? Where if you look at what the typical investor is holding, your point number one was diversify, right? Poor diversification. If you look at investor portfolios today, including institutional portfolios, they have more equity risk than ever, which is a bias to favorable growth, right? And easier money. They have more equity risk than ever. They have more U.S. equity risk than ever, 67% of the total world market cap, which means almost 70% of all the dollars that are going to equities need to go into U.S. equities to keep the price the same. More concentration than ever, the Mag 7, so-called Mag 7. And the top 10 is 30% of the market, which is the most ever. And the valuations is near the highest ever, right? And particularly for a foreign investor investing unhedged into the U.S., the dollar is also at near the highest level ever because of the favorable view of the U.S. and favorable actual outperformance of the U.S. economy over the recent decade or so. And you've got all of those converging at highest ever, which then means if you translate that into what's being discounted, a very favorable set of circumstances is being discounted, and there's a really narrow path for that really working out to get a good risk premium on that particular portfolio.
My guess is if you asked the average investor looking forward, is this a world where you want to be more diversified or less diversified, meaning greater or less uncertainty? My guess is most people would say, I think I want to be more diversified. Yet they're probably less diversified now for the reasons you just laid out than they were 10 years ago.
Exactly. There's a reason we are where we are now. It didn't happen randomly. In the last decade and more, the U.S. has been the best performing economy, and U.S. companies have been the best performing companies. And the earnings growth that has actually supported that pricing up to now, right? So like you take the Mag 7, they've had a 20% annualized earnings, but it's discounted to be 13% a year. And if you look at the rest of the market, the other 493, they've been sort of dragged along because they're now discounting roughly 8% earnings growth in the future to have a normal risk premium, and it's never been that high. Theirs was 5% looking back. It's discounted to be 8, and it's never been that high. So the U.S. market has been dragged along. The total market has been dragged along by the outperformance. And this idea of U.S. exceptionalism reflects that, yes, over the last decade, the U.S. did have exceptional performance, and it was not discounted a decade ago. I don't know if people don't recognize that, but a decade ago, the tech sector was not really priced that much differently than the market, and the U.S. was not priced that much different than the market. And then all of those things vastly outperformed, which led to, relative to discounted, great performance. But now it's discounted to continue into the future or more. And so it's you're betting on a lot to have that concentrated position. And I agree with you on the global diversification that I think this is a tremendous opportunity for global diversification. You go back to the 70s and 80s, and global diversification was the thing to do. Then you hit the kind of the 80s and 90s, and with globalization and global capital flows and global trade, China comes along, and China's got a currency that's pegged to the dollar. Their monetary policy is connected to the dollar. Asia was just manufacture and export to the West. It was a singular global economy and a singular global market. And the correlations between markets got very high, 80, 90%. And everybody's like, what's the point of global diversification? But now, if you look at this world of modern mercantilism, tariffs, the involvement of governments in business activities, as well as the differences in fiscal policies, the difference in monetary policies, the differences in inflation rates, and the differences in how countries dealt with COVID. And particularly Asia dealt with COVID through social measures, and therefore they've never had an inflation. The US and Europe, UK, the West dealt with it by printing money and fiscal stimulation, which then caused the overheating. And so we've been getting a negative correlation between the East and the West because of that complete difference in macro circumstances. And we're getting the echo of it now, even forward, right? The secondary effects of that, combined with the need to diversify because of the uncertainty that's created by what governments are doing in the markets, right? So I think that the expected correlation of global markets is now low again. And actually, it's an opportunity and actually a necessity to diversify globally. If you don't diversify globally, you don't want to be sort of randomly hit by one of these circumstances, and there's no reason to be concentrated because you can be reasonably globally diversified. The super optimistic conditions that are discounted in the United States are not discounted in other countries. So the discounting is very different.
So we talked about risk a little bit, but would you tell us how you think about risk? What does it mean to you?
It's not the standard deviation of returns,
That one's easy to measure, but there's probably a lot more dimensions to it.
Yeah, as an example, if you always made money, but sometimes you make 5 and sometimes you make 25, you'll have a high standard deviation of returns. Risk is the probability of an adverse outcome, and I would say an unacceptable adverse outcome. And so it's really, a loss. It could be a loss relative to a future commitment that you have. It could be a loss in absolute terms, but it's an unacceptable outcome. And so you have to know what is your unacceptable outcome, and then don't get anywhere close to that. Don't sort of, go close to the edge and be precise about it. Allow for a cushion against the unacceptable outcome, and then build a portfolio given that.
And I assume part of that process isn't as simple as here's your allocation, go back in time and look at that allocation in 2008, 2009, the 70s, et cetera? And would you have reached that pain point that is not acceptable? Because a lot of things in the future are probably going to happen that haven't happened in the past. So that's just part of the experience.
Yeah, there needs to be a logical assessment of that. Yeah, I agree with you, but it's hard in a vacuum, right? And so the great thing about assessing risk in markets is that you have a lot of markets across a lot of countries over a long time frame. And so, for example, if you're talking about the equity market, you always want to look at Japan. You want to say, I mean, here is the at that time, second biggest or what economy in the world, certainly one of the biggest market caps, and now you hit a 70% drawdown, right? So if it can happen, so I mean, it's not a third world country. It's a developed economy, really intelligent, capable people, but the system got out of balance, and then you had a deleveraging. So put your investment strategy through the Japan scenario. We always go back to the Great Depression, right? We go through the 20s and then the 30s and then the 40s. Look at that scenario. Is that acceptable? How would you deal with that? We've done that for a long time. And then taking that kind of perspective was very important for us is when we came into 2008 and the financial crisis, and then the period after that of the deleveraging. To be able to understand those circumstances, really, you had to look back at the 30s to understand the dynamics of that, or you had to look at Japan. So there are a lot of scenarios in the markets that you want to stress test your strategy through that are helpful, that you don't have to have your imagination. And then beyond that, you actually have to think about what else might occur.
And which is another way of saying the more diversified you are, properly diversified, less the drawdowns. That's the simple math of it.
Yeah, and there is no magic asset. In 2020, Ray went back and did a study of every asset in every economy, 35 economies, not every, 35 economies, going back over a couple hundred years. And what you saw was that every asset in every economy, including cash, experienced at least a 50% decline in its purchasing power within the span of a decade at some point or another. Gold, cash, stocks, bonds, inflation index bonds, every single one of them in every economy, every asset class, at some point in history, there was a decade where the purchasing power declined by at least half. And if you look back over, even recently, if you look back, I mentioned Japan, but if you look back at the 2010s, cash in the US and Europe suffered about a 30% decline in purchasing power over the course of a decade because you think it's a low risk asset, but it's low risk in nominal terms, but it's very high risk in real terms, in purchasing power terms, because we had a positive inflation rate, a couple percent more for a decade and a zero interest rate. So every year you're giving 2 or 3% away, and it suffered a 20 to 30% decline in purchasing power over the course of that decade. And we all just sat right through it and experienced it. And most people don't register that. So cash is not even the safe investment. You need a diversified portfolio, and then you can across related to those kind of environmental biases, and then you're still going to have losing periods, but yet then you still have to expect it, and realize that when it happens, don't throw in the towel.
So going back to the things you can be sure about or highly confident about. So asset classes should earn a positive return through time. But what you just described is also really insightful, which is that each individual asset class has had a material drawdown historically, probably too much pain to live through, and therefore is very possibly going to have the same thing in the future. And so if you know that they're going to do well over time, but if you over concentrate in a single asset class, you could suffer intolerable pain. So given that backdrop of the things you can be highly confident about, how does one go about building a resilient portfolio, just conceptually?
Well, conceptually, the first thing you want to know is how risky is each asset in its, let's call it, native form. Like if you just go buy a stock, how much does it go up or down? If you go buy a 10-year bond, how much does it go up or down? If you go buy gold, how much does it go up or down? And then you want to, first of all, figure out how much you have to adjust the holdings of each one of those so that they would be of similar risk. Okay. If you hold the same amount of dollars in stocks and bonds, but stocks are 4 times as volatile as bonds, basically your risk is the stocks. Okay. But if you hold an equal amount, and you're not getting diversification. But if you're holding a comparable amount of risk in two things, you are getting that diversification. And you don't have to be precise about it. I remember a few years ago, the short story, I was watching it, kind of had a little bit of free time to myself. I was sitting on the sofa and my sister-in-law calls. And the stock market had been going down for a few days. And she called, and my wife comes over and says, "Hey, Jennifer wants to know if she should sell her stocks now." and so
She called the wrong person.
and so I was like, okay, should I answer this question once and for all, or should I just let this go? And so what I did was I said, okay, I'm going to answer this question once and for all. It's not the first time that it came through, right? And so literally I took a yellow sticky pad, this, like this. And I went onto the Vanguard side and some different mutual fund sites. And I was looking for the measure of the standard deviation of the funds, and it wasn't even there. So I was like, well, it doesn't matter. So I just said, okay, stocks is, let's call that a 15. Let's call gold a 20. Let's call bonds a 5. And then just on a yellow sticky pad, and I said, okay, if I was going to balance risk across these things, how much would it be? Okay. And it's pretty straightforward. So that was the answer. So I ended up calling that my sister-in-law portfolio. And then I was having a meeting with a major sovereign wealth fund describing these concepts. And I told the story. And later, when I got back to the office, the message came in, "Hey, can you send me the mix of that sister-in-law portfolio?" and I also I was at a conference, and same thing. I told the story, and then at the break of the conference, like everybody wanted to know what was the mix of that sister-in-law portfolio. So anyway, it doesn't have to be complicated, but the starting point is just what we're talking about. But by and large, is the risk level a 5, a 10, a 15, a 20, or a 25? Put it in a bucket. Know how many dollars you need to hold in one thing versus another to have them roughly similar risk. And then diversify across things that have different environmental biases. Something might do well in rising inflation, something in falling inflation, stronger growth, weaker growth. And just do the best you can on that, and you're going to achieve 80% of what you need to achieve.
And so I guess the way to think about those asset classes, it's like a package of returns. It's a stream of returns that has some history that you can observe, and it has some future pattern. And the key to understand is each of those represents exposures to various factors. And what you want to diversify is not the line items. What you want to diversify is those exposures. And that's how you can compound wealth through time, because you're basically diversifying the risks that are easily diversifiable.
That's right. And then, you know us very well in that kind of very simple way. But, in recent years, it's been interesting to take those ideas forward and say, well, what if I only held an equity portfolio? We had a client a couple of years ago that asked us to propose a new approach. The only problem was their portfolio was almost entirely equities, and they couldn't use leverage. So you had to figure out, how do you do asset allocation if you're really just holding equities? And so that really forced us to kind of broaden our minds more to the overarching concept of resilience and minimizing environmental bias. which you can do many more ways, even than what we're talking about. If you understand, you have a whole set of companies, and different companies have different environmental biases. Their earnings streams have different environmental biases. Obviously, oil companies do well when oil prices go up. Some others do badly when oil prices go up, right? And so you can actually diversify the earnings streams of those companies, which has been a really important thing, particularly in recent market action, that to kind of, get through that. And then the other thing that we've done is to carry forward those ideas of the environmental biases of global TAA, extending those concepts, meaning if you can build in each economy, now I can then look at all the different economies and see which one is most conducive to assets in terms of liquidity conditions and monetary policy. And then also, even within that economy, the growth or inflation environment will automatically then favor stocks versus bonds versus commodities. And so you could tilt in that direction. And recognizing environmental biases of assets are also, those concepts are universal enough that they're extendable in many other ways, which is, you asked the first question you asked me was, are you still interested in what you're doing kind of thing, right? And that's exciting stuff because the founding strategy of risk parity and even extending into just the equity market where you have to create degrees of freedom by separating the cash flow stream and the drivers of that versus the discount rate and the drivers of that.
That framework of investing is very different, at least in my experience, from the way most people do it. And the way most people do it, including a lot of large, sophisticated portfolios, is they think returns come from stocks. All the other things are diversifying to stocks, but they lower your return. So you balance between higher return, more stocks, lower return, less risk, more other things. And that framework is just completely different. And at the end of the day, it's not that diversified because most of the risk is in stocks.
Correct. I totally agree with you. To do what you just described is hard, right? It's hard to say which stock market is going to do better. When are stocks going to do well? When are they going to do poorly? You're just stuck with that equity market decision with a lot of risk and probably too much risk. And so your only choice is just don't take very much risk. Hold a tiny amount of stocks and a lot of bonds. Or just take too much risk and sell after things go down. You could just have a diversified portfolio of currencies or diversified portfolio of assets and allow for that risk premium to compound over time, through that good diversification.
So we just walked through the kind of the science and the engineering of building a portfolio. And I put that on one end of the spectrum of a well-balanced, well-diversified portfolio. At the other end of the spectrum, you have a more conventional portfolio. And as we talked about, the conventional portfolio isn't that diversified. But the advantage the conventional portfolio has is that it's more familiar and it often becomes a reference point for investors. So if we move into the psychology of investing part of this, meaning how do you practically implement some of the science, what science proves through time, how do you think about navigating that spectrum for the average investor? Knowing what you're supposed to do, what the science says, but comparing it to what everybody else does and your reference point, basically how is the stock market doing? And how do you think about navigating that spectrum and just conceptually, how do you think about it?
I think the answer is different if you're a professional investment manager managing somebody else's money and you're being held to that as a benchmark versus if you're managing your own money and you have some other purpose for your savings. But I think if you're actually held to a benchmark, you're a professional manager, you're held to a benchmark, you need to explicitly know how much tracking error you're going to have relative to that benchmark. And you might actually, even if it makes for a less efficient portfolio, you might actually have to hold some of that asset in order to measure the proper amount of tracking error, right? And so that's, we have to do that when that's what's called for. It's nice to have the freedom to not do that, right? It's much better to have the freedom to just say, I'm going to build the most efficient portfolio, the highest return per unit of risk, the lowest probability of hitting the adverse outcome that I referred to earlier. And we do these things we call a cone chart, right? Which is like, what is my range of outcomes over time? And as long as I'm inside that range, I'm achieving my own goals. And I have to be making my decisions based on my goals, what I need the money for, how much risk I can take, and build this strategy for that, not what somebody else might have done or what I could have done or something like that, because that will draw you into the mistakes that everybody else is making. And like I said today, what everybody is doing effectively, what the average person is doing, is holding a highly concentrated portfolio in a limited number of stocks in the United States, and taking a lot of risk in doing that. And the problem with risk is that you only feel it after the fact, and after the fact you can't do anything about it. And so we were just talking about the fires in California, and that was a risk that pre-existed, but you don't really feel it. And then afterwards it's happened, you can't do anything about it. In the markets, what happens is you have that risk and it's out there, it's latent. It may happen, it may not, but it may. And after it happens, it's too late to do something about it. And that's when you really understand it. But the time to manage your risk is before things happen that are unacceptable. So you have to know your unacceptable outcome, and you have to know whether your portfolio or your investment strategy is going to be inside that cone of what's acceptable.
One of the challenges that I've experienced in the last couple of decades is that you could reach a logical conclusion about what your portfolio looks like. And so that's this kind of one end of the spectrum. And then you have what everybody else does. And the challenge there, even if you know that it's not efficient, you hear about it every day, right? It's in the newspaper, it's on TV, and it's, the stock market's doing well. And your friends are talking about it, and it's part of conversation. And so it's like you have a belief, but over time, because these periods can last a long period of time, you're swayed to go to the other way. So the risk I see in terms of practical application of some of these concepts that we're talking about is you have to be able to hold firm to that strategy, whatever it is, through those periods, knowing that it's going to last a long time and it's hard to predict. And that can be really hard because it's constantly dripping on you.
Well, yeah, exactly. And a rise in real interest rates has a negative impact across assets. Now, if it happens in a favorable growth environment, that favorable growth environment, and particularly a big tech revolution, favors equities, right? But today, the real bond yield is not negative 1.5. Today, the real bond yield is positive 2.5. So from this point forward, it's a different set of circumstances than where you were. And so you shouldn't look back and say, oh, that's going to, that's what I should expect going forward. You'd have to expect the real bond yield to go from 2.5 to 4.5 or something like that, which would be the top end of the last decade or the last, 100 years or so. The second, and then the more general, so number one is do an attribution. Understand why. Was that logical? Is that repeating? Does this make sense to me? The second thing I think is very important is the return of a portfolio or the return of an asset reflects a whole number of things that are coming together, right? If you look under the hood, are the underlying premises that were the basis of me making that portfolio, are those things holding true? If the underlying premises are holding true, and the return is just at the bottom end of the range, then I can expect that in the future that I will achieve my expected return. So for example, a simple example is if I'm looking at a stock, right, and I'm buying this stock, and I let's say I have the expertise to believe that their earnings is going to grow by 10% a year, right, and with very high positive free cash flow and so forth. And now that stock goes down. Okay, you could say, well, the stock went down. Is that a problem? Well, you didn't necessarily predict that it was going to go up or down this year, but you thought that there'd be a 10% earnings growth. So the question is, was there actually 10% earnings growth? If there was 10% earnings growth, then and you continue to expect 10% earnings growth, then actually your underlying premises are holding true, and that's likely to work out for you over time. One of the things that I look at is I look at what's called I call it a diversification ratio. And so the test of that is if I add up the volatility of all the assets that I hold relative to the total volatility that my portfolio experienced, is that ratio roughly 2-to-1? So the assets, if the assets were all 100% correlated, I get 20% vol, but actually I got 10% vol on the portfolio. So I was getting the diversification that I expected to get that's working, right? And if my diversification ratio is still 2, I'm getting more risk premiums. This is going to work out. Everything's working fine. Whereas if I hold, let's say, a 70-30 portfolio and my diversification ratio is like 1.2. So fundamentally, the portfolio is performing better. It's just in this particular period, the return might have been worse because of the other set of circumstances. So are the underlying premises holding true? And have you done a proper attribution of your returns to know why it did what it did, including on the upside, right? You might have got lucky on the upside, but understanding why the return was what it did in terms of those underlying drivers that we're talking about.
And one of the additional challenges, if we kind of jump into the psychology side of all this, is you look back and you look at real yields went from -1.5 to 2.5 to +2.5. Of course, that was going to happen. Right? They're not going to stay that low forever. And so part of the challenge and all of this and the attribution is the narrative comes into the picture. And the one thing that's almost as powerful as compounding is hindsight bias, not quite as powerful. But you look back and say, we knew that was going to happen. I knew it was going to happen. My gut told me. And as a result, I can't trust that my strategy. So that folds into all of this, which makes being, thoughtful and sticking to the plan for a long period of time very hard in practice.
It is. That's what markets are like, which is why, what is the statistic that the average investor in a mutual fund has had? You might know this better than me, but it's something like, negative returns, even though the average mutual fund has gone up a lot. Right. The experienced return of the holder of the asset has done much worse than the asset itself has done because they get out at the wrong time, as is along the lines of what you've been saying. That's the emotion of the game, right? And I always think that a really important criteria is if I build a strategy that today, looking forward, I'm going to build a strategy that when I look forward, on the day that I'm losing money, will I still have confidence in that strategy? Right. So do a pro forma, a stress test on yourself. Do I believe in this thing enough that when it's lost money, I will say, oh no, this is going to work out right. This is a good strategy. Or do I start to waver, right? And if I start to waver, don't do it in the first place.
Right, because your experience won't be good. Because whatever the strategy is, you can look at it as single manager, any return stream. It's going to go through an inevitable period of underperformance, however way you measure that. So you're right. If going in, you know that it's going to go through a bad period at some point, and it's hard to predict when, and you know that your reaction is going to be to sell it, your experience probably won't be good.
Yeah, and I think it's very different mentality than what you're kind of drawn to as an investor. As an investor, you're really drawn to, oh, this is going to be a great investment. This is going to work out great, right? Otherwise, you wouldn't do it. And so you're sort of like, oh, you're excited about it. This is going to be a great strategy. And then you just have to temper that. And you have to say, hold on, it's going to lose money. When it loses money, will I still say the same thing? Or will I waver a little bit? And if you're going to waver, just maybe take less risk in it. And that applies to everything we do.
One of the patterns that I've observed on the institutional side is it's very typical where you're hiring a manager, whatever they manage. You hire the ones that have outperformed in the past. It's very unusual to say, they've underperformed for a long period of time, but this is their moment. So you hire the outperformer. And then when they underperform for a long enough period where you can't stand it, you're going to fire them. And because we know managers are going to be cyclical through time, nobody persistently outperforms or underperforms, then you end up with a generally bad discipline to compound wealth over time. It's really interesting how that happens, but it persists.
An example of this is value managers, equity in the value in the equity market. You probably remember the study we did a couple years ago. We took every equity value manager that since 1970. We got a database of 3,000 some equity value managers. All the equity value managers that ever existed, all the ones included, the ones that went out of business. And starting from 1970, if you just held the equal average of all the value managers through time and say, what was that return? It was about 100, 150 basis points higher than the S&P. But the 10-year return had half the range. If you take their different 10-year returns, it had half the range of the S&P. So they actually had a moderately higher return and a much more consistent return than the S&P, which is that's what you would want, right? Higher return with half the risk, half the long-term risk. But if you look at the total amount of money invested in value managers, it's about the same as it was in 2007. Even though since 2007, the stock market is up a ton, the total amount of dollars in value managers is about where it was in 2007, which is telling you there was a persistent selling of their of those assets to buy the hot thing in the thing that had lesser performance. Because at the time they were having the consistent return, and that was underperforming the hot return, and so they sell one and buy the other.
Yeah, and I think part of that is it's almost like humans are hardwired this way. That you can see past returns, you can't see future returns. So even though the warnings say don't extrapolate the past into the future, I think our natural inclination is to do exactly that. And then you get this momentum where you start to see underperformance, and you extrapolate that into the future. And then this is why buy high, sell low keeps happening. It's pretty fascinating how it repeats.
And literally, the fact that a price went up more means that a more favorable outcome is now discounted for the future. The more the price went up, actually, the lower the chance going forward that it'll outperform what's discounted. So that also is working against you.
Yeah, which kind of goes back to where we started, where the things you can be confident about is the benefits of diversification. Compounding is how you build wealth over time, and just don't mess it up. So my guess is most investors shouldn't try to time, because that's lower odds of success. And unless they're one of the top 5 in the room, which obviously most people think they are, but most of them are wrong, they can probably do more harm than good. And that kind of goes back to just be diversified and forget it.
Yep. Build a well-diversified, well-constructed, properly diversified portfolio. And today, global diversification is really, really valuable, useful, and the opposite of what most people are holding. Because I would say today we're probably holding the most concentrated portfolio ever. I did a study also at it was called Life Cycle of the Market Champions, going back over the last 100 years, basically taking in 1900, what were the 10 highest market cap assets? Like 7 of them were railroads, right? 1900 and 1910. Wow, railroads are hot, man. Railroads are going to be great. And in every decade, there was a set of companies that was the favored set. And it goes kind of railroads, and then it goes to chemicals, and then it goes to oil companies. Today, it's the tech sector and a particular segment of the tech sector. I think is an interesting thing to consider. So in every case, you had the market champions, and in every case they faded, every single one, right? They didn't necessarily go out of business, but they became less significant. And I think an example to think about today is IBM. We have a tech revolution going on. We have the tech sector comprising almost half of the total S&P. IBM is not mentioned. And yet you go back 20 years ago, 30 years ago, it was IBM. In fact, to such an extent that it was unfair, right? Monopoly power and all that kind of stuff. They're a tech firm. They're not even mentioned. So when you have a DeepSeek comes in, and that hurt, the effect of DeepSeek on NVIDIA, what about the effect of NVIDIA and the rest of the crowd on IBM? That's the process of creative destruction in the economy. That is how the economy grows. It is through the process of creative destruction. And it's fed by the process of complacency of the current market champions, and then maybe overinvestment. So it's very hard to see the future as a different version than today. But when you go back and you take those time slices through history, you see that it's a very unstable, the market champions is a very unstable group, and that the powers of creative destruction are at work at deciding who the winners and losers are. The aggregate keeps going up. The aggregate economy keeps growing, and you want to participate in that, but to have a concentrated exposure in today's champions is not a very safe place to be.
And I'm sure if you studied the narrative during all those periods, it was extremely bullish to support that concentration.
Exactly. That's how they got there.
You've mentioned that you've observing a lot of regime shifts today. Would you walk us through some of those?
Well, it's an interesting dilemma that we're in right now, because from a cyclical standpoint, we've been going through 5 years of imbalances, right? We think about economies in relation to what does equilibrium look like. And equilibrium we define equilibrium as spending is in line with output, debts are in line with incomes, and there's normal risk premiums on assets. And in the last 5 years, we've had severe disequilibriums across most economies. First of all, we had a near deflationary depression from the COVID. Then we had the stimulation. Then we have the overheating. Then we have the inflation. Then we have the tightening, inverted yield curves, and so on and so forth. And we are, after 5 years of effort by policymakers to bring us back into line, we are actually converging on about as good a set of equilibrium economic conditions as we've ever had. Okay. And that's normally a decent environment for assets. It's not a super great environment, but it's a good environment for assets. A diversified portfolio would typically give you your average excess return in that environment with a little less volatility, and that'd be good. Against that set of circumstances, now you bring in, first of all, the pricing. It tends to be optimistic in the United States, not so much globally. And then you bring in the very proactive government activity, what we call modern mercantilism, which is where economies are focused internally, where governments are focused internally on doing things that are best for their own economy. And the orientation is much more around competing instead of cooperating. And the idea of globalization and global capital flow movements and free markets is out the window. And it's much more around, pulling the levers to manage your own economy in relation to others. That has, first of all, in the United States, we haven't done that very long. And are they going to be any good at it? So is there going to be capital wasted? Are we going to cause inflation and so on and so forth? So that brings in a lot of uncertainty. China has been doing that for a while. They're pretty good at it. They've got a big challenge right now, but they've been doing it for a while. Europe doesn't even have the governance structure to have a strategy. They don't have a central government. So Europe's in a particularly bad place because the US is doing things that are maybe bad for Europe. And China is outcompeting Europe. The US is outcompeting the tech sector. China is outcompeting in the manufacturing sector. They've had very low innovation, very low productivity, and no central government, to basically steer the ship and figure out how to compete in this world. So that's register that problem for Europe, which you're seeing in the currency. Then when you go to the U.S. and you look at the policies, this nice cyclical equilibrium that we were coming into is challenged by the policies themselves. Tariffs are inflationary. Reduced immigration is inflationary. And the U.S. inflation rate is it's just hovering at the top end of acceptable for the Fed at a time that wages is still pretty high. And the only reason we've been able to get away with high wages and high nominal spending is also running at too high of a level for the 2% inflation rate, unless you get high productivity. So the U.S. economy is very dependent on a productivity miracle, high productivity continuing into the future. And the more you cut back on immigration, the more dependent it is on that. Because it's been the expansion of the labor force through immigration that's allowed actually wages to not be higher than they are. And as you curtail that supply of labor and you keep spending the same, you have upward pressure on inflation. So the policies themselves are generally inflationary, though they could also be negative for growth. We do the calculations. The only way to really deal with this mercantilist type of a policy is to literally sit down and go through the calculations of import by import, export by export, price by price, company by company, and tally up the impact of the first order effects, the retaliatory effects, and so forth, and just calculate bottom up what is the GDP impact of that and what is the inflation impact of that. And the 25-25-10 mixture of tariffs we calculated was about a 25 basis point negative for the U.S. economy. So not overwhelming, but a weakening of the economy and a positive to inflation. The effect would be much, much bigger on a Mexico or on Canada, where in the 1% to 2% type range impact on real GDP growth. Not a huge impact on China. And China doesn't export that much into the United States, particularly not directly. And a 10% tariff is smaller. So you start with the basic cyclical picture, which is coming into a reasonable set of equilibriums around the world, which should generally be good. Too optimistic pricing in the United States, that can be dealt with through global diversification. Tariffs, which can really only be understood by going at the very detailed level and can also impact one company a lot more than the aggregate. And therefore, diversification, right? You don't want to be concentrated in the wrong company that's nailed by that. And then I guess the third thing is the relative equilibrium that we've achieved in the United States has been achieved by about a 15-year period of the government stepping in and taking on a lot more debt and allowing a deleveraging in the private sector and a strengthening of household balance sheets in the private sector. And that has left the U.S. government with a big fiscal deficit, but also a big stock of outstanding debt. So U.S. debt to GDP has gone from about 70%, where it was for decades, to about 120%. The fiscal deficit's about 7%. It's probably going to be that or higher going forward. And so that's what you're left with, is that the U.S. economy, you have to roll over the debt, right? And so you have both the new issuance and the rollovers of the existing debt. The rollovers of the existing debt is occurring at a higher interest rate, which is then increasing the deficit. And that can have compound effects over time. Ray's actually done a good study of this, and he's writing a book now on the math of that process. And so it's a precarious situation, and it hasn't come home to roost because the U.S. economy has been stronger, the Fed's been tighter, U.S. rates have been higher, U.S. companies are the tech sector's doing better, and so there's been plenty of capital flow into the bonds. But you're going to be issuing, the U.S. government's going to be issuing 25 to 30% of GDP every year, as far as the eye could see, of bonds. And while you normally roll over the bonds, the holder of the bonds has to choose to do that. And if the holder of the bonds is a foreign government or someone who doesn't necessarily want to hold the bonds anymore, you're susceptible to that. 43% of the outstanding debt is held by either foreign entities or the U.S. central bank. The Fed doesn't want to roll over the bonds anymore. So that's a situation. Debt rollovers is not something people pay a lot of attention to, but if you look across emerging economies, it's always the inability to roll over debt that is the currency crisis and the financial crisis. It's not the new issuance per se. It's the combination of the new issuance that also scares people out of the rollovers. The rollovers of U.S. Treasury debt is going to be a big issue going forward, both because of the rise in the interest rate that's going to get paid and the potential that the people that hold the debt don't want to roll it over.
It sounds like one of those latent risks that you described earlier, which is nobody really cares about it until it becomes the most important thing as you cross that tipping point.
After it happens. That's also one of those cascading risks. If it happens, it doesn't happen in a small scale. It's like the avalanche tipping point risk. So I think we're in a world where you just can't say, I'm going to hold the world asset or I'm going to hold the market cap asset. You literally want to be thinking about each country and each asset and how vulnerable it is to these influences, and then diversify across the ones that seem to be, free of harm.
And then kind of bringing it full circle, recognizing that the conventional portfolio and the average portfolio is not that well diversified. So understand that there is going to be some difference there, which means you'll have more tracking error of your more diversified portfolio versus what everybody else does, for better or for worse, and just appreciate that before the fact.
And achieve your goals for your savings or your investing.
Bob, this has been great. I appreciate you sharing your insights, taking the time to walk us through everything. And I always enjoy our conversations, so thank you.
Great to talk to you, Alex.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke advisors, the podcast host, or their services. Similarly, The inclusion of a guest on the podcast does not imply that Evoke Advisors or the host endorses the guest or any company with which they may be affiliated or employed. Evoke has neither paid nor received compensation from guests for their participation.